The softer than expected US inflation data sparked a buying frenzy in the US stock and bond markets yesterday. Then, the softer than expected British inflation data came to support the idea that central banks' efforts to rein in inflation are bearing fruit. Now, of course, the week doesn't end here, and investors will be watching very closely the US retail sales data due today, the big retailer earnings due today and tomorrow, and pray that a road accident in the US politics won't spoil the cheery market mood. So welcome, this is Swissquote's Daily Market Talk. So the Fed those went crazy yesterday with the sight of a slightly lower than expected inflation report. The headline inflation in the US fell to 3.2% in October from 3.7% printed a month earlier, and core inflation eased to 4% from 4.1% printed a month earlier. And looking deeper into this data, there are actually two things in that inflation report that actually made investors happy and soothed. Well, first was printed a lower than expected number for both the US headline and the core inflation numbers. So of course, that is a outright positive for the market pricing. So that was a great source of relief for investors, especially given that the expectation for a fall in the headline inflation figure was already quite large, mind you. So beating a strong expectations was a wow effect yesterday. Plus services excluding housing and energy costs, so the so-called super core inflation figure closely watched by the Federal Reserve members, rose only 0.2%, and shelter costs in the US rose only 0.3%, down from a 0.6% advance that was printed a month earlier. So overall, this inflation in the US made the headlines at yesterday's trading session. The soft set of inflation print from the US boosted the Federal Reserve doves, obviously, and cemented the expectation that the Federal Reserve is really done hiking the interest rates. So the US 2-year yield, which captures the Fed rate bets, tanked 24 basis points yesterday to 4.81% level. The 10-year yield slipped below the 4.5% level, and activity on Fed funds futures now gives around 95% chance for a no rate hike in the Fed's December meeting. So that probability stood at around 85% before yesterday's CPI data. So as a result, equity investors were also having a great day yesterday. The S&P 500 went through the roof at yesterday's trading session after the inflation data. The index easily jumped past its 100-day moving average, spiked above the 4,500 psychological mark, and closed the session a few points below that level. And Nasdaq 100 extended its gains to 15,850 level. We are now just a few points below the summer peak in the Nasdaq 100 stocks. In the FX markets, while the US dollar took a severe hit yesterday, the US dollar index fell 1.5% at yesterday's trading session, pulled out a major Fibonacci support, and sank into the medium-term bearish consolidation zone after the US inflation data. So the euro dollar jumped to almost 109 level. Yes, there's no mistake here, it jumped to almost 109 level and cabled further with the 1.25 resistance. What a day, really. And also note that good news came from Britain just this morning, because inflation in Britain fell to 4.6% from 6.7% printed a month earlier. So that was lower than penciled in by analysts. Core inflation, on the other hand, also is more than expected to 5.7% level. The latter helped investors swallow the strong wages growth data printed just yesterday, and which showed that wages in Britain grew almost 8% in the month of September. So that's obviously all the extra pounds that the British people will be spending on stuff to counter their cost of living crisis. But looking at the overall data, well, there is now growing evidence that the major central banks' efforts to rein in inflation are actually bearing fruit, and cable is sold after the CPI data, but the pullback will likely remain short-lived if the US dollar appetite continues to wane globally. So this brings me back to the US. Now, the knee-jerk reaction that we saw yesterday to the US inflation data was perhaps a bit exaggerated, so the rally was likely intensified by a rush to fresh long positions in the US Treasuries, but also by a hurry to cover short positions. Now, we could obviously see a correction in the US yields following yesterday's big move, as the Federal Reserve members still maintain their position for higher for longer interest rates in the US. But obviously the market position is clear right now. The pricing now suggests a 50 basis point cut from the Federal Reserve by July next year. And the sweet and sour cocktail of softening jobs market and easing inflation will suggest that the Federal Reserve's next move will probably be a rate cut rather than a rate hike. Now, of course, a rate cut in the US also brings along the expectation of somehow slowing economic growth, even though it doesn't look like it from this point in time. And this is why the jobs market loosens, and this is why inflation falls, right? But that doesn't necessarily matter much to investors as the Federal Reserve's rate path, because the Fed's rate path is much more important than what happens to the economy. So yes, ladies and gentlemen, the way is being paved for a potential Santa rally later this year. The Fed will obviously remain cautious and try to calm down the game and investors' nerves, as a rally in stock and bond markets could obviously jeopardize its efforts to fight inflation, and any figure hinting at the strength of the US economic data should and could tame the Federal Reserve, those moving forward. And in the sense, while investors will be watching the all-important US retail sales data that is due later today, a strong figure could pour some cold water on the Federal Reserve's rate cut bets. A soft figure could bring in some more buyers into the US Treasury and stock markets. Now, on the individual front, Home Depot shares rallied more than 5% at yesterday's trading session, even though earnings and revenue narrowed at Home Depot, and even though the company released a cautious year-end guidance, while the third quarter results were better than expected by analysts. Now, Target is due to report today, and Walmart will be reporting on Thursday. And to add another layer of complexity on top of the economic data and the corporate earnings, the US political scene is also going to impact the pricing in the bond markets in the next few hours and the next few days of trading, as obviously, as you know, the US politicians now try to avoid a government shutdown that could happen by the end of this week, by Friday, if a resolution is not found. So the latest news suggests that the odds of a US government shutdown diminished yesterday, as House Speaker Mike Johnson actually gained more Democratic support for his interim funding plan. Now, note that that interim plan excludes aid for Ukraine, it excludes aid for Israel, and it could lead to a two-step shutdown at the start of next year. So it is not ideal, and it does also not include the steep spending cuts that the US hardcore Republicans are looking for. So all in all, the political mess continues in the US. In the best case scenario, we will be seeing another short-term relief for the US government, and the US will hence avoid another government shutdown, and that could also diminish the threat of another rating cut from the Moody's this time, and that would be just quite good for the markets because nobody needs a rating cut for the US. And that could finally help the US bonds remain in bid and support a further rally in the US stocks. In the worst case scenario, however, the US government will stop its operations by the end of this week, and the political chaos in the US will lead to a bounce in the US yields and perhaps solve the equity rally that we've been seeing since a couple of days. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive feedbacks. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. And follow us on Instagram, on X, and on LinkedIn for regular market updates. And subscribe, of course, to our YouTube channel for daily market comments. And please do not forget to hit the like button on these videos to let us know that you actually do enjoy them. So I will meet you again tomorrow. And until then, good day trading.